What's going on today, YouTube? Hope you guys all had a great weekend, enjoyed the Super Bowl, and just kept on it. Today, I want to talk to you guys about long-term investing in the stock market and understanding that it does have fluctuations. Now, if you're new to my channel, I come out with new videos daily. I talked about long-term investing, short-term investing, value investing, anything, anywhere you're putting your money into. I even have some Bitcoin videos just because it's the hottest trend right now, and a lot of people have made a lot of money off of it. I've made a little bit of money off of it. But any type of investing, I'm here to help you guys learn, succeed, and learn how not to lose money in the market like the majority. Let's get out of the majority, guys. Let's be the ones that do it. Alright, so, stay to the end, and I'm going to tell you guys 3 things you need to ask yourself if you're in a long-term investment situation before selling off your stock. Now, if you liked everything I talked about in this video, leave a like. Like I said, I'm here for you guys. Let me know what you want to know about the stock market or any investment in general, and I will make a video on it. So, like, share, anything. Get this word out there. We want to beat the market, not be like everyone else. Number 1 thing I want you to realize, if you're a long-term investor, people tend to forget that bear markets are possible when we're in a bull market for more than 5 years. And as you can see, this behind is just the regular S&P 500. It's the index. And we've been in a bull market pretty much 3 years now. Or you could argue we've been in a bull market ever since 2008, really. It's done nothing but up. We had a little scare right here in 2015, but that's about it. So, whichever way you want to look at it. But, another thing real quick, it's funny, isn't it? Even on the S&P, look, it has like a top here, bottom here. Just funny how it hits those twice. That's why I like technical analysis also. That's for another video. So as an investor, you must understand the market fluctuates. That is the biggest thing. You can't get scared if it falls or if it goes up. And one key point, you should never buy when you see a substantial gain on a stock, on an index, or anything. And you should never sell after a substantial loss. As an investor, when you start to worry about these unduly declines, you take your biggest advantage and make it into a disadvantage. And I understand that these mutual funds and these indexes, why they all replicate the same way, things you need to be aware about. They must replicate the market by buying high and selling low. It's one thing. Another thing, they have multi-millions of dollars to invest. So they can't invest in these tiny companies because they'll raise their price through the roof and hence make them overvalued. So the only chance they have is to invest in well-known, big, large companies. So, for example, when a mutual fund does well the previous year, they tend to get a lot more investors. Since they have a lot more investors, they have a lot more money. So they have 2 options. Either buy more of what they're already into, hence rising the price even more, making it overpriced, or looking and doing more research, which costs them more money, which costs you more money, so your gains are going to get smaller and smaller. And then, when the stock market starts to fall, investors panic and they take their money out of this, and that, again, keeps the cycle of buying high and selling low, which is the opposite of what you need to do. You need to buy low, sell high. Go over this in other videos, check them all out. And these mutual fund managers, they want to beat the market. They get raises and bonuses and stuff when they beat the market. So they can't afford not to own the same overpriced companies that are the largest companies. Largest companies on the stock market, they can't afford not to own them. So they just keep on pumping more and more and more money into them. Yes, hypothetically, these large companies, they're not going anywhere right now, so they're safe for now, but everything gets overpriced eventually. Everything. And for these mutual funds to stay with these indexes, they must sell a stock when it becomes too cheap. They must sell a stock when it becomes too expensive. Or even when a company gets too large or a company gets too small. They are forced to sell these just to stick with the index, because if they, once again, they beat the index, they get their bonuses, and they all want their bonuses. So things you can control as an individual investor. Number 1, brokerage costs. You can't control how much they charge, but you can control how much you buy and sell. Long-term investor, you want to at least hold, when you're buying something as a long-term investor, you're banking on at least holding it. You want to hold it for at least 5 years. Minimum of 1 year. Number 2, if you do decide to invest in mutual funds, find the mutual funds out there with the lowest fees. Number 3, make your expectations realistic. You're not going to beat, if you're investing in individual stocks yourself, most likely, most of the majority will not beat the market every year, year in, year out. So have your expectations realistic, stick to a plan, don't get too confident, don't get too cocky. You know, confident, cocky, it's good to a point, but when it gets too far, you're in trouble. Number 4, you can control how much you are willing to risk in the market and always do your rebalancing. Hence, rebalancing the percentage you have in stocks or in bonds. If you want to have a certain percentage in stocks of your money and a certain percentage in bonds, you got to check it every quarter, every year, whenever you want to, and make sure that percentage is staying the same. Number 5, hold for at least 1 year, and this will lower your capital gains tax. And number 6, control your own behavior. If you're in for the long term, stay in for the long term. Always go in having a plan. If your plan is to stay in for a year to 5 years, make sure you do that. Don't buy it and panic when the market starts going down. If you do this, you're not the long-term investor. You're short-term, and you should probably go after swing trades more than anything else. For a long-term investor that plans on being in the market for the next 20 to 25 years, your best bet is to dollar cost average. And dollar cost average, you're going to invest the same amount on the same day every single month, no matter what the price is. Don't even look at it. Don't even care. And this, mostly what I'm talking about here is index funds. You can buy cheap index funds such as Vanguard. They replicate the S&P 500. This is the S&P from 2001 on. And that is VTI from 2001 on. It replicates. Those charts are almost identical. So, like most of us, we don't have the money to buy a share of the S&P. So you look for low-cost index funds that replicate the S&P, the NASDAQ, whatever. So, as a long-term investor, be aware, as humans, we are pattern-seeking animals. So we look for fluctuations, and that's why we try to beat the market. But if you're going in for the long term, and you want to be an investor that's not worried about the price of his stocks every day, day in, day out, going in for the long term, highly recommend low-cost index funds. And also, the reason we do like to trade our stocks is because when we're right, dopamine's released in our brain. It gives us like a good feeling sensation. And when we're wrong, we get the fight or flight response. And this is what makes us panic and sell when a stock price is going down. If you're in for the long term, you can't care about what the price is doing. You invested in the index because you believe it's going to, over time, like I said, next 20, 25 years, is going to go up. So, 3 things to think about before you sell your stock. This is for the long-term investor. And this is, in essence, it is the same thing. So as a long-term investor, you need to realize these fluctuations are real, and dollar cost averaging, why it is a great thing. When the market's high, if you're investing the same amount every month, you're going to buy less shares. When it's low, you're going to buy more shares. So on average, your middle, you'll always get the average value. You'll buy less high, more low, less high, more low, and you'll buy right at that price when it's right in the middle. So over time, that is why dollar cost averaging is a great thing. The next time you're thinking about selling your index, whatever you're invested in, ask yourself these 3 questions. Number 1, do you check the market price of your vehicle every 5 minutes? Treat the price of the stock like the vehicle. You're not going to call and ask, is my price of my car, has it gone up or has it gone down? Number 2, say you were worried about the price of your car. Would you rush to sell your car if the market price of it dropped all of a sudden? And number 3, from not checking the price so often, did I prevent the price of my car to go up? These 3 principles are the same exact thing in the stock market. Ask yourself those 3 before you move on to actually executing your sell. I hope this video helped you. I hope you learned something. If you like the content like this, subscribe, like. I come out every day. So share this video, get the word around. My whole goal is to allow you guys to make money in the market. I'll see you tomorrow.